Now we have the pleasure of trying to unpack what happened over the weekend. We have it coming out in our insights for tomorrow for those that receive them, where we try to go into, what does it mean? What has happened in the past? So when you look at the numbers in general, it averages out to about 1.7 million barrels a day reduction, or 1.649 if you want to be specific about it. But the question is always, is it coming from production, current production levels? Is it coming from quota levels? And the reason why that matters is because if it's coming from quota or production, Saudi Arabia, UAE, Kuwait will be cutting, but Iraq won't be, because Iraq is actually well below their pledged cut. And for an example, so the Kurdistan situation took about 400,000 barrels a day of production offline. They agreed to a cut of 211,000 barrels. Well, they're not producing 400. So the cut of 211 is actually below what they're currently taking out of the market. So it's going to come down to, what does this really mean? What are they trying to address? And for those that pay attention to this the most, there are going to be three places to watch. One, exports. Are exports going down? If they're trying to cut production, exports should be falling. Two, what is floating storage doing? Land storage, especially in these locations, are much harder to see. Shipping is the easiest way to kind of dictate how much storage is out there. Three, what are OSPs? Not so much from the Middle East doing, but outside of the Middle East in terms of West Africa, which would be kind of your next backdrop, as well as Brent. So those are going to be kind of your bellwethers to see what is happening at the moment and what does it mean in general. So when you look at two different sides of it, there's the bullish setup. The bullish setup is OPEC Plus, led by Saudi, is looking to protect that $70, $75 Brent put, where prices will be supported to keep things well above 75, and trying to hug what we think is like what they want is about that $85 Brent. The bearish side of this is OPEC Plus is seeing demand diminish, and we'll show you in a minute what that looks like in terms of underlying storage. And they're trying to get in front of the drop in demand to protect the price and keep storage more normal. Now, it's important to understand that the bullish and bearish setup, they're both right, because if it's getting bearish in terms of the level of storage, therefore cut, so then you can clear some of that storage and keep the next level of prices elevated. And so the whole point of that bullish and bearish kind of push and pull is, this isn't going to take us to $100 Brent. This isn't going to take us to $150 Brent. This is going to take us to 85. The what is kind of that trading range of, let's call it 82 to 87 on a Brent level, with trying to hug and average that 85, which is what I think the underlying goal is. So when you look at some of the different flows in general, just in terms of where we are, it's going to take time for the market to digest things. And if you remember, the last time OPEC cut 2 million barrels a day, there was ahead of a fairly sizable drop off in demand. Again, the U.S. storage situation is showing that there's already some increase in demand, but then you're getting some flashed warning signs from Singapore, from crack spreads, especially on the middle distillate side. So then you might think, it's like, all right, well, they're going to try to take some volume out, but they're going to try to help the refiner and try to protect the refiner, which you would do by decreasing OSPs, or at least trying to keep them flat. And so obviously that didn't happen. And you had Saudi Arabia increase OSPs going into Asia. They kept some of them the same. Some of them increased slightly. When you look at Europe and the US, we'll talk more about that tomorrow in the FSC show. We just want to look at what is happening right here. And the key one to look at is always light. And you can see there was an increase in 30 cents per barrel. So again, you're seeing those increases against the differentials, and it's going to be difficult to see that how it's going to hurt refiners. Like refinery margin is getting pulled down, and it's going to make things difficult and where they try to make a margin, which again is going to shrink some of that demand as you get more economic run cuts just because of where things are. And to put it into perspective, now, this chart, just because Bloomberg is a bit delayed on updating it, this blue line doesn't have the increase. So it's actually a little bit higher from here, but you get an idea that looking at the last 10 years, this is the second highest OSPs for light crude going into Asia have ever been. And what this is also doing is this is actually benefiting because now the euros are being pulled closer to $60. And when you look at Japan, the headlines were Japan broke with the G7. They bought Russian crude. Then there was another headline that came out saying, well, they got permission to do it. Regardless, it's going to be difficult for countries to try to compete in this market without buying the cheapest volume possible. And if you can't get Middle East, obviously you're going to struggle. There is a lot of West African crude available, but it's still priced above Russia. So if you're a country that is seeing your economy slow, inflation a problem, and you're staring at a ship containing discounted crude versus some slightly discounted West African crude or expensive Middle Eastern crude, which one are you going for? And that's the struggle that they sit in, and Saudi knows that. So what do? They just cut this back. Russia is supposed to reduce their production by 500,000 barrels a day. That is more a structure of, again, the issues between exports and refining. And so what we've been saying is that Russia had no choice but to cut production because they have nowhere to store both crude and the refined products to the level they would need to, which is why that's kind of normal. But again, Saudi doing it, Kuwait doing it, UAE doing it is showing, of carrying favor with Saudi. The question is going to be, how does the UAE interact as they have more production coming online? So they might be saying, look, we'll play ball with you right now and we'll reduce production. But when we start to bring new production on, we want our baseline moving up. And these are the kind of conversations that are happening in the background. Net, it just moves us back into the trading range. Again, like I want to say something profound, saying like, oh, this is it. This is going to take crude to 150, or oh, this is OPEC admitting that the economy is imploding and we're going to go to 50. No, the goal was to keep it here, and that's what they're achieving, and that's what they're going to continue to do as we continue to see some of that degradation on demand. This is going to keep rates moving higher from the central bank's perspective. It's going to put more pressure on demand, and that's where you're going to see these pressure points, and that's why it's similar to the 70s. Again, even as demand has come down, supply is also coming down, and that's where we saw this problem point when you look at the 70s and where we are today. On the Econ show, we showed that if copper demand continues at these levels, we're going to run out of storage by August. And again, there's a problem with how are we sourcing product? Where is the product coming from? And then, as they say with commodities, the cure for high prices is high prices. So when you start looking at the Middle East, these are some of the things that they're looking at. So yes, you have 2016 with the very elevated storage. That was on the back of the price war. But when you look through from 17 to 2022, floating storage is very high, and it's in line with 2021. And based on what was happening prior to the cut, it's going higher. And so they need to get rid of some of this crude. So when you look at that, you could say, well, they had to do some sort of cut, but doing it from May to January, December 31st is a long period of time. They're like, they could have done it for a month or two, cleared this out, and then reassessed. But I think they really wanted to send that message to the market that this is what they're looking to do. But then on the other side, there's that counterbalance to what does it do to the economy. So then when you look at U.S. exports have moved higher. This is going to keep exports for the U.S. very elevated. We've moved much closer to 4 million barrels a day of exports. So we're butting right up against kind of the physical maximum. And it's just, we expected to be at 3.7, 3.8. We're now going to be firmly at 4 million. And that's going to be a good thing for us in terms of kind of moving this, capturing price. But the question is going to be, can we maintain those flows? Now, when you look at middle distillate cracks, or gas oil cracks in Asia, you can see that we're now well below 20, bouncing around and coming further down. This is the concern. This is more because of OSPs and because of that steady build of storage, because this is what is going to weigh on refining activity. This is what you have to look at when you have to consider, are these refiners going to shut down due to economic run cuts? Because gasoline, like distillate's still a problem. It's not going to stop being a problem. This was the only saving grace, and the move is, things are not looking all too good. And we're going to talk more about what the expectations are for Chinese exports in the next few slides. So here, when you look at the flip, here you can see the strengthening of Dubai versus Brent, and Abu Dhabi's front month, as you can see, exploded higher. It moved over $1 after the Saudi announcement. So now Brent is actually cheaper than Dubai, and you can see just how rare that is in terms of the pricing. So again, you should start to see some additional Brent moves. So that's why you then want to look at Brent. What is happening here? Are we seeing more sales? Are we seeing, and right now you've started to see a little bit more of cargoes getting snapped up, but nothing meaningful. Therefore, it's still early. I'm not saying that it's going to happen immediately, but these are going to be important things to watch. And this is another key piece that they were probably looking at. Global crude oil on the water is moving back to 2023 highs. You can see it's already well above where it has been previously. Obviously, 2020 was the shock of COVID, but you can see here that there's a lot of crude on the water that they want to clear. They want to try to normalize. And that's something that is also going to be a driver for some of these reductions. Crude oil in transit actually shifting back up. As you can see, well above where it is. They want to try to get this crude off the water, as floating storage is now pushing above 2021 levels, or just right at, but right now moving above 2021 levels. We were assuming that storage was going to be closer to 2022. But again, you saw this extra shift, and a lot of this is that Russian product that has been coming into the market that has been complicating things. And because of that Russian product, you've seen sizable increases in both Saudi Arabia, in both the Middle East, in West Africa. And what are they trying to do but clear that, trying to adjust for that? And again, that's why we saw these cuts. But all of this excess on the water is, again, that counterbalance to why we're not going to 150. We have to look, is this clearing? Is it clearing faster than they expected? If it's clearing faster than they expected and they don't change that cap, you could start to see that movement back up. But we just think that there's going to be a slowdown in demand as we go into May, especially the summer driving season, which is going to be that counterbalance to the drawdowns, which is why we're pretty confident about that trading range at the moment, with Asian floating storage again trending back up. And prior to the numbers, China's buying of supertanker crude increased, still at the highs. The problem is China's still buying seasonally adjusted speaking, all-time highs, but yet you're still seeing Angola struggling to sell. You're still seeing Middle East with excess cargoes. And because a lot, if not all of this is, I shouldn't say all of it, I should say a lot of this, or the difference between what is normal and what is happening right now, is Russian flows. Russian flows is this big piece, which is why we're seeing, even though China is a big buyer right now, or at least more than normal, you're not seeing the benefit in West Africa or the Middle East at this point in time. Chinese congestion moving down a bit, but again, still at that level. It'll still stay elevated. We're going to talk more on the econ show. Some of the data is cooling off a bit as you're going to get that nice big shock or big increase following the lockdowns ending, and then you start to get some of that normalcy, and we expect that to continue to trend down a bit, but just closer to where we were in 2022, not like we're going below the previous. Now, when you start looking at refining activity, it's peaking its head again. We're going from 62.6 to 63.3% utilization rates at the Shandong refiners. And now it's just going to follow that trend, which is going to be a fairly steady increase as guys come out of turnaround, and you start to see some of that demand internally, but also as they look to export. West Africa, yes, some of that crude did move, but you can see it is still well above average. And that's the problem with when you start looking at Angolan flows and Nigerian flows, which have been some of the bigger headwinds. U.S. exports, gasoline increased 33,000 barrels a day, still above the 5-year. Distillate increased 108, still below the 5-year. Then you look at propane. Propane dropped 488,000 barrels a day, but again, still very strong versus the 5-year. That's going to remain. And then total crude exports came in at 5.2 million barrels a day. Again, still well above physical capacity. But again, it's just because you have some of that makeup number as the data comes through, as some of it clears. But as we come into the first week of the month, remember this is looking at last week. So as we come into the first week of the month, some more of this will catch up. Now, when you look at gasoline, as we were saying, it's going to stay above the 5-year. It's just going to trend a little bit further down. But it'll still be at the high end of the cloud when you look at against the 5-year, just closer to the 5-year average. Where distillate is going to trend below that level, just because we've had some sizable drawdowns. The math makes it make sense to stay local, and that's again, we're still going to see an increase in exports. It's just going to be below what is the 5-year average. Then you look at crude oil exports. Again, it's going to stay strong. We've been talking about that. Propane, propylene coming down, but again, still seasonally all-time highs. We're still going to keep setting these records. Nothing too crazy there. And then when you start looking at ethane exports, it's bouncing around, but those are going to come back up. Now, when you start looking at some of the other areas, so in Fujairah, you had a build in middle distillate, withdrawals in light and heavy. So in total, the storage fell 2.7 million barrels. Light distillate fell 1.647, which sounds like a lot, but the East of Suez gasoline complex actually softened as we got into April, and it's continuing to soften here on out because Indonesia gasoline demand was expected to rise, but now it really isn't post the fire at the Dume refiner. And it's because they have a lot of inventories, and you're not seeing a huge demand increase. So they were deferring about 1.5 million barrels. That's again suggesting kind of inventories are pretty stable. And then China was expected to export between 800,000 metric tons to 1 million of gasoline in April, up from the estimated 300,000 in March, as domestic demand is expected to be less than previously anticipated, which again is why we have this kind of merge of. And why we've talked about China, where there's no reason for these refiners not to run a bit hard, because they still have fairly frothy export quotas that they still haven't used. So if you can run at where you want to, run elevated, and you can either dump it into the domestic market or move it into the export market, which is still available. Middle distillate increased 479,000 barrels. East of Suez gas oil market opened the week on a weaker note, with market participants preferring to stay on the sidelines due to volatility. But some traders said that the arbitrage lanes to send gas oil to the West is still closed. There was a possibility of Indian Arab Gulf cargoes being pointed towards Asia, which could add to the regional supply volumes, which is going to complicate things, because that's also where Russian flows are going. So then, on the other side, there's an expected leaner availabilities from China in April due to refinery maintenance and a preference to keep barrels domestic. But as we get increases in refinery utilization rates, that's where China is going to kind of be the bellwether, because people are expecting diesel from Russia. People weren't expecting India Arab Gulf to the same level. China is going to be the swing, and we think it's going to kind of split the difference. Some's going to stay home, some's going to get exported, and you're going to see those builds continue in Fujairah and Singapore and Asia, which is going to pull down crack spreads and again result in some of those economic run cuts. Heavy resid fell 1.544 million. Spot trading was fairly light right now. It's just kind of, there's really not too many bids. Some of this was just general movements. So realistically, when you look at it from the outside in, we do see builds getting more elevated, but the middle distillate growing is going to be the one to watch, because again, that's the driver for a lot of these crack spreads. Brent time spreads bounced, but you could see they're still hugging down by the near the lows. We think it'll, at this point, just based on things kind of settling out around this 85, you'll see time spreads hug about this 36 to 40 cent ratio. Then when you start looking at flows, Nigeria is actually increasing volumes in May. When you look at Angola, they're keeping things fairly stable. Libya is going to hug just above the million. The question is going to be Russia. Angola, Senegal reduced the price for a cargo of Girasol crude for May loading again, and again that was even before the surprise supply cut, and you're still not getting too much in general. So that went from $2.50. It went from $3 March 27th, $2.50 the 31st. And now it's at $2.20 as they again try to clear this. But the bigger issue at this point is Nigeria is still struggling to find buyers. They still have more than 20 shipments for April loading, still looking for buyers. And that's similar to 10 days ago where they had 20 to 25. Now, as some of the protests end, that will clear some of it, but you're still seeing kind of that backdrop of, or the difficulty of, well, how are some of these cargoes going to clear, and why some of these adjustments were made from the Saudi perspective, because they want to keep prices elevated. And as these cargoes get stuck, well, prices will come down. So how do you keep prices there? Well, they'll take it off the market and try to get more premium. But yeah, then it comes down to how much more money are you making, but you're selling less volume. And then it comes down to, was it worth the risk? So you took 500,000 barrels a day off the market. What price increase did you need to not only make the same amount, but more to make the cut worthwhile? And that's going to be an interesting one to watch, which is why we're talking about focus on exports. Exports will be the key. Genscape, when you look at activity in Europe, are again remaining flat. That's something that we expect to see small, pretty much stable, just in terms of what comes. We do have refiners coming back a bit. You do have some of that floating storage, which will come on. Now, when we look at flows, gasoline built again, but you had some drop in gas oil. Gas oil is kind of hugging more of the normal range, which is why the ARB coming from Asia into Europe, or I should say the Atlantic Basin, really isn't there right now. And then it's also trapping fuel oil in the region. And gasoline, again, new all-time highs, new high for 2023. It's just going to, at some point, this is going to open up and dump into the U.S., which is why we remain cautious on how much volume does the U.S. really need? Because if the prices get high enough, you're going to unlock a significant ARB coming from the European market into the U.S. East Coast. Where fuel oil, again, staying at the highs, just given the difficulty of margin and the ARB, that's going to remain the case. When you look at Singapore, there was a small drop. Again, overall, you're still above that average, and you're still hugging the top end of that range. And the reason why is, even though you had a drop in light distillate, you're still at all-time highs. And given some of that back and forth with additional Chinese cargoes coming into the market, Indonesia not needing what it was, people got a bit bullish, including myself, in terms of that fire and what that would mean for volumes. Never materialized. And again, we see that being playing out here. And the biggest concern is that steady increase in middle distillate, because this was the margin that people were relying on, and it's disappearing. And as that gets eaten away, that's where you're going to see more economic run cuts. And in the near term, over the next month or two, you could see those economic run cuts, which would reduce the amount of crude demand. So not only are you getting this, but you're also getting the slowdown economically speaking, especially in Southeast Asia, which again is going to limit some of that upside, with resid and heavy disti still staying at the highs, and a lot of that is with additional Russian flows. North Sea, again, staying at the lows. Typically, you kind of you come to the low, and then you start to increase. As we have some additional fields, coming out of maintenance, that'll be the case. And then when you look at European crude storage, you had a massive increase in European crude storage, which is why we're talking about how those European flows and European land storage is going to see that benefit. You're going to see some of those increases, which again, it shouldn't move crude prices up or down, but it's just giving you an idea of some of the balancing act that's going to happen. So that's what we have for you today. If you have any questions, again, find us in the comments section or on Twitter. And if this is the show that you watch and you don't watch the Econ Show, we hope you have a happy Easter, a great long weekend, and we will talk to you next week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.